Hello, my name is Eddie Tofbig. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of the patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Paris milling wheat. Much like Chicago and Kansas City wheat, one single pattern has been the cause of the rising prices here seen throughout July. A pattern I highlighted a few weeks ago, a mid-May to early July based diamond bottom pattern, highlighted in dark blue on my daily chart. And a move up easily reaching its primary and harder to reach secondary topside targets. A week after we closed outside this pattern, we had a strong gapping move higher through the green short medium moving average, currently 218.25, and the 50% Fibonacci line, the important 50% absolute Fibonacci line at 218.75, and the March to May 24 move at 230.25. The market started slowing after pushing through the combination of the previously drawn bright red upper tine, which is currently 244.5, and the purple neckline extension, currently at 244 even, of the June to November 2023 head and shoulders top. The market breached these, but today has turned low, what looks like a very large combined bearish long engulfing pattern and very long key reversal down. The move lower pierced the 50% Fibonacci line at 230.5, but stopped short of the bright red middle time, which is currently at 229.25. That came in quite well actually in support there. Now these two would be the first levels I would look to see some support forming, though I'd also keep an eye on the 50% Fibonacci line at 227.25, the new recent late June to July 26 move, and an especially close eye on the gap left behind between 223.25 to 224.5, 223.25 to 224.5. Now, one more thing to say, and I've said it elsewhere, but it is worth saying again, is to deal with this rise as what is called a vertical run-up pattern. In such a move as we have seen, about 2 out of 10 times we see a further continuation higher, though not as swiftly. Most of the time, so 8 out of 10 times, we see a retracement of some or all of the run up. A rough medium is about half the move up is retraced, though about 2 out of 10 times see a full retracement. However, the retracement is usually short-lived. In our rough guide, it's about a month or so long. The only exception is those that have seen that further continuation move higher, where it becomes a bit problematic. This is how this period is worth considering here in this situation, and also in the other grain markets as well. Minneapolis wheat. Much like Chicago, Kansas City, and even Paris wheat, there is one single pattern that's been the cause of the rising prices here seen throughout July. A pattern I highlighted a few weeks ago. It is not a diamond pattern here. No. It is instead a mid-June to mid-July based V-bottom, a pattern highlighted in early July after a break higher from an earlier late May, early July bear channel. The resultant gapping move up from this bullish pattern pushed up through the mauve medium moving average, currently at 666.25, the green short medium moving average, currently at 670.5, the 50% Fibonacci lines of the May to August 24 move at 669.5, a number of highs and lows, notably the high seen back in May, which is in a congestion area between 723.75 to 737, admittedly sparsely populated compared to what we have moved up through, but still a significant top at 735.5 and close to the June 21 low at 643.75 to finally slow down at the August 2017 high at 753.5 before the congestion between 768.75 to 778.25, and that contains the July 21 high at 778.25. The recent actions allowed me last week to draw 2 new patterns, and I was not happy about doing so, as I would have preferred to draw just the one. But circumstances dictated back then that I should draw the 2 in the hope that they might show the bullish angle of attack, or of the market overall. They are a bright red mid-January to mid-June bullish Andrews pitchfork, a shallower bright green bullish shift pitchfork for the same move. As I said, and I say now, I am not happy about drawing these 2 things side by side, preferring to just draw the 1, but it needed it then. However, the price action now means that I can retire the shallower bright green shift pitchfork after this commentary, which is satisfying to me. The action today is that of a key reversal down, and the immediate support is twofold. Firstly, on a closing basis, that old May high at 735.5, and secondly, the low is on the congestion between 723 3/4 to 727 1/4. Notably, the late May high at 723 1/4. However, there is further support below between 701 1/4 to 708. Then the bright red middle tie, which is currently at 696 3/4. Then the new 50% Fibonacci line of the late June to late July move at 681 3/4 before we reach the July gap between 662.5 to 677 1/4. It's a really interesting one below, as not only contains now the green short medium moving average and the medium moving average, but also the earlier mentioned 50% Fibonacci line. It should be cumbersome to deal with if we get down that far. Now I have one more thing to say. It's to deal with this rise as what is called a vertical run-up pattern. In such a move up as we've seen, about 2 out of 10 times we see a further continuation higher, though not as swiftly. Most of the time, 8 out of 10 times that is, we see a reactionary or some of all the run-up. So we've seen a reactionary move back down of some or all of the run-up. A rough medium is about half the move up is retraced, and about 2 out of 10 times seeing a full retracement. However, the retracement is usually short-lived. A rough guide is about a month or so. The only exceptions to those is that we have seen a further continuation move higher when it becomes problematic. The only exception is those that have seen a further continuation move higher, then it becomes problematic. This is worth considering here in this situation, and repeating, I suppose, and also in the other grain markets as well. London UK feed wheat. As I've repeated here for months and months, there are 2 long-term key patterns here to bear in mind, both with a common neckline extension, currently at 169.40. Now I've detailed these patterns in the past, but we are now sufficiently away from the common neckline that I will now suspend extensive discussion of these for now, or at least until prices start coming back there again. In the recent action, much like Chicago, Kansas City, Minneapolis, and even Paris wheat, there was one single pattern that has been the cause of the rising prices here, seen here throughout July, a pattern I highlighted a few weeks ago. It is not a diamond pattern here, no, it is a small double top, formed over June and early July, which still managed to keep within the core pattern here, which is a really good pattern, as I will demonstrate on this daily chart, and that is a purple end of June, late October 25 bullish shift pitchfork. The price is racing up to be halted over the last 3 days and today for dramatic key reversal down at the top, at the purple upper time, which is currently at 209 even. The recent action saw a gapping move up with change over the rising mauve medium moving average, which is currently 179.55. The significant 50% absolute Fibonacci line at 180.5. The green short medium moving average, currently 182.85, as well as a number of middle tines and a bright red head and shoulders neckline from March to May 2022 head and shoulders top, which is currently 193.30, until prices peaked just over the 2022 low at 206.5. This leads me to my final 2 points, and they have a common thread. They are patterns based on the same period that I drew last week, and I don't normally like doing such a thing. However, I drew a pink late December 25 to late June bullish Andrews pitchfork and a shallower dark blue bullish shift pitchfork for the same move, the late December 25 to late June 26 move. As I said and I say, I was not happy drawing these two side by side. I preferred to just draw the one, but it needed it then. However, the price action since then now means I can retire the shallower dark blue bullish shift pitchfork after this commentary, plus the bright pink upper tine, currently at 210.20. Well, I won't retire that one, but it's just bear that one in mind. No doubt assisted. Now this bright pink upper tine no doubt assisted the purple upper tine in capping the purple upper trend line, I should say, in capping prices today. Both of these things are very satisfying to me. The big key reversal down we have seen today finished closing just above the August 21 high at 199.20, which is the first support. We then have the congestion of the bright red neckline and the pink middle tine, which is currently at 192.65, which is not too far from the new 50% Fibonacci line on the June to July 26 move at 190.25. However, I think better support exists below the first gap between 188.75 and 189.75, where the purple middle tine, currently 187.45, crosses the bright green April to May small head and shoulders neckline, currently also 187.45. If prices drop down below that, well, it becomes very interesting. Now, one more thing to say, and I've said this elsewhere, and it's to deal with this rise as what is called a vertical run-up pattern. Such a move as we have seen, about 2 out of 10 times, we see a further continuation higher, though not as swiftly. Most of the time, 8 out of 10 times, we see a retracement of some or all of the run-up. A rough medium is about half the move up is retraced, with about 2 out of 10 times seeing a full retracement. However, the retracement is usually short-lived. A rough guide is about a month or so. The only exception is those that have seen a further continuation move higher, where it becomes problematic. This is worth considering here in this situation, and also in the other grain markets as well. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.